So as I'm saying, this is for my future self and just for sharing with my colleagues. Please ignore, don't look at this. I mean, this is bull crap. This research is not good. And if you believe in what I'm saying, then most likely you lose money, and it's not my problem, it's your problem. On with it. So this is Sterling Tools, and basically they are in the business of making these sort of bolts, nuts and bolts, and yeah, and they are used in automotive. So what happens is you require very specialized bolts, countersunk bolts and all, which will go inside your sheet metal so that it's not visible, or it will give the required sturdity and rigidity. So that's one of the main business. Their other business is into these MCU. Now the pictures that they have given are not MCUs, but I mean they have given these are inverters actually. But they make the motor control unit, and there's also motor supplier. So somebody supplying the motor, and these guys are putting in the motor control unit. And most likely, the motor supplier is also giving the characteristic curves and all of those things, which they provide to the OEM. And the OEM, like Ola, for example, uses that motor and drives the vehicle and all of those things. So interesting business, but this is the main anchor customer is Ola, and that is kind of growing. Over here, the two-wheeler is almost 93% of their revenue, and 7% is from three-wheeler. And this might grow as the LCV part of the segment grows. For their standalone business, which is basically these nuts and bolts business, here again, OEM is 86%, replacement market is tiny, 11%, export is 3%. And the end user is mostly PV and then two-wheeler. So as two-wheeler segment recovers, or as the industry as a whole recovers or improves, they kind of grow 1-2% around the industry growth rate. That's what I understand. Um, so this is they make high tensile fastener. Bigger problem is their receivables are rising faster than sales. This is a location breakup, so mostly they are domestic in nature and OEM dependent, and industrial segment, farm segment, commercial vehicle, two-wheeler and four-wheeler. This is the breakup. Um, and then aftermarket versus OEM. These are the various customers that they have. I think the top five are the biggest customers that they have. Now I'll go down a little bit. They talk about the Sterling Group and also the plant location over here. So four manufacturing plant in the north and one in the south. Um, so this is, sorry, SGM one is in Faridabad, so somewhere over here. And then there are two tech centers in Faridabad and Bangalore. And there's also one manufacturing plant in Bangalore. And this is a STL manufacturing. And we'll come to that later. So there are some triggers for that. So this has been the overall growth of the business from incorporation in 7981 to currently 2024, 23, 24. And these are the various bolts that they do and the certain standardization. This is the SGM business. So motor control units, these are the motor control units, but these looks like DC-DC and inverter controllers, but we'll see STL clientele. I mean, they are present with everyone almost. Yeah. Now let's get back to the projection sheet. So green is the management provided commentary and red is the derived commentary that we have got. I'll just expand it a little bit. All right, so what the management says is FY23 revenue was 772 crores. FY24 it grew by 67 crores. And SGM was 23% of the business in FY23. Quarter 1 FY24 it grew by 33% and Quarter 1 FY25 it grew by 43%. The management expects by FY28, the SGEM part of the business will grow by 60% and the standalone business will stay at 40%. The standalone business has around a capacity of around, I think, 800 crores. That's the max. Um, Here they talk about the delta. So, for example, they say that FY26 might be a good trigger because there would be many launches. Just a second, I jumped. Yeah, so okay, another thing. So industry grows at a rate and they grow at a certain delta to the industry. The management is confident that they'll be able to grow 2-3% at the growth rate of the industry. Yeah, so they'll grow at the rate of, I mean, just a delta to the industry growth rate. They're also doing a debottlenecking capex over here. Where did it go? Oh yeah, debottlenecking capex. So that is done in Bangalore, and we can see that revenues might grow by 20-25%. They also talk about that revenue somewhere before that it is around 750 to 800 crores. So as a bull case scenario, what I took is in FY 27-28, they should reach 700 crores of revenue. So by FY 26, they said that, where did it go? Yeah. So they will reach around 8 to 10% of EBITDA levels. Oh, sorry. And also, yeah, their Bangalore plants will reach to around this capex utilization will be around 45 to 50%. And they are also doing a balancing capex, and the Bangalore is not fully optimized. So by FY 27, they'll reach an optimization level over there. And after that, they probably don't need any capex in the standalone business. That is the nut and bolt business. Yeah. And so we kind of consider that over here we'll get a jump, or maybe this jump will come a bit later. We can always play around with that number. Or maybe we bring it over here, but whatever. Yeah, I don't know. Why does it? Just a sec. What happens if I put it here? I don't know. Everything goes haywire. Anyways, yeah, so that's the idea. And so, yeah, what was I saying? So debottlenecking capex. So your standalone revenue at FY 23 was 598 crores, and in FY 24 was 613 crores. And I'm expecting that the revenue will improve at this rate. This number is not correct because this would be E, sorry, D. So, ayo, sorry, this is correct. This is D. Yeah. So it kind of grows at 7% to, and there's a jump at 13% maybe, and that gets divided into 2 years or somewhere on those lines. And FY 28, you get around close to 800 crores of sales. What is interesting is the SGEM revenue. SGEM was 174 crores, which was 23% of the overall sales in FY 23. In FY 24, it became 323 crores, which was around 35% of the overall sales. In FY 25, it was around 121.6 crores, which is around 43%. And if I annualize it, it goes to around, say, this into 4. So if the management is able to deliver, this could be the number that we can see. But I am being a bit more conservative because the management had guided in one of the question that they might not see a very high growth. So management said that lower teen growth over here, so 15% or maybe around here. But there could be some surprise. I mean, EV Fame 3 or EV sales might be a good surprise. So that way, FY 25, they can close at 419 crores. And then, I mean, they said that by FY 28, they target that the SGEM revenue should be around 60% of the overall revenue. Now, if I back calculate that the STL revenues kind of reach the 800 crore mark, and your SGM revenue is 60%, so you kind of get to a number of around 1200 crores, which is decent, not bad, right? And your sales growth is also not bad. I mean, 15%, and they can grow like that to 14%. Not too high, but FY 26 or FY 27, we might see a very high growth here. That's the idea. Also in FY 27, management had said that they expect a lot of various this thing. I think FY 27, lots of MCU businesses will kind of come. Let me see in the sales trigger. I think I had, yeah, this one, rational development. So lots of projects that are going on that is 2 to 3 years out, and from FY 26 or calendar year 27 onwards, they might see larger amount of businesses in the SGEM part. So that's the overall sales and top line growth thing. So this is the number that I'm kind of comfortable with. And the growth is sort of decent over here. This is growth of revenue. Yeah, growth of revenue for the SGM business. So 85% growth, and then kind of tapered it down a little bit. This year I've tapered it down, but next year I've kind of pulled it up. Next or the year later, there might be um, something good, but that's the idea. From the capacity point of view, SGM is around supplying around 4,000, um, sorry, 4 lakhs versus maximum capacity of 6 lakhs. So utilization is also 66%. So if I take peak capacity, then it comes to 485, 484 crores. And the peak capacity should max by FY25 or maybe H1 FY26. That's number one. Um, Also in the capacity part, oh yeah, this is the capacity that they're talking about, 400 crores, 80% utilization. Uh, they're making around 2,000 units a day. So if you take 200 days, so that comes down to roughly 4,000 to 5,000 units, and they have 6,000. So some debottlenecking and all of those things they talk about. Okay. Then they have another JV with Yonin. Now this is interesting because they talk about this over here. How would be the partnership between Yonin and us? So they say that it will be a JV structure and our feasibility studies are completed. Right now they're investing 20 crores and then they'll evaluate. By FY25, maybe FY26, not FY25, but calendar year 25, so FY26 onwards, or second half of FY26, they'll start supply. Maybe I took it from FY26, second half of FY26. Maybe I should just shift it a little bit. Yeah, this one. Maybe what I could do is make this into 100, and what I could do is make this into maybe 200. Yeah, and then decent FY27 full year we get a benefit, and then we also grow that business quite nicely. I think I'm taking around 20% growth rate on the business. Yeah. So okay, that's about it for this one. Then EBITDA is around so quarter four was 108 crores, out of which standalone was 90 and SGM was 17.4 odd crores, and this is pretty decent. The standalone business throws cash pretty decent. EBITDA margins 14% for the standalone business, and SGM was 5.39%. The management wants to bring it to 12%, so low double digit. So somebody asked that you're localizing and all of those things. What about EBITDA margin of the MCU? So they said no. That's the thing we've spoken. We believe that steady state EBITDA margin of the business will be in the low double digit. But it's not something that we'll be able to get this year. It's something that we'll aspire in FY26 or maybe FY27. So I've taken that as the projection FY27 as at 12%. Oh, another thing. In the Yogin, this thing, so they talk about the partnership, magnetic and all of those things. So magnetics is essentially like transformer, common mode chokes, EMI filters, inductors. Basically, when you're transforming current, either you're reducing the voltage or from a higher to a lower voltage, or you're using a transformer. So these are components which are used in automotive as well as non-automotive assembly. So this is basically a DC-DC. Okay. Our partnership will be in automotive, in chargers and battery management system. I don't know in the battery management system, but in the DC-DC, they'll be using it. Uh, Blah 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 blah. And then localization, they talk about localization and all of that. And then going forward, they also talk further that look, their customer is Hyundai and Kia. That's already going to be there, but they'll also have Tata and Mahindra and some Japanese OEM will come, and it's a JV. So yeah, so that's the idea. Um, yeah, and then capacity utilization, they talk about it. Oh yeah, capacity utilization. So Ayush asks that, look, you've done almost 450 crores of capex for the last 6 years, and there would be some maintenance capex. So you're not actually making too good money. I mean, there's no ROC. So they say that, look, we have done a lot of greenfield capex in Bangalore, so the land cost and infrastructure cost was kind of large, but then going forward, debottlenecking capex will not be that large. And also, I think the time that they bought and probably right now the appreciation of the land price that has also doubled or tripled. So book value would be very high. And so as revenues come in, it'll improve the ROCE number. So that is also kind of reason. And they talk about the margin structure. So they feel like around 15%, give or take. That'll be the margin structure in the base business. Uh, and there's also a bit of commodity, like with the fluctuation of the steel price, uh, margins can go up and down. Um, so they are kind of like a converter. So yeah, their margins kind of stay as is. So EBITDA margins, as I said, improved, and with Yojin, I expect a 10% margin EBITDA level. It shouldn't be less than that, but I believe it could be more, but maybe it might not come from FY26, but a bit later, maybe FY27 or 8. So maybe out of 10, I can put it as 5%. Yeah, little change. Other income stays as is, but this is mostly from your cash and investment. Maybe I also add that part, investment. So a little bit of your cash and investment, and then your interest kind of stays the same. I don't expect the borrowings to substantially go down or go up. However, in the cash flow statement, you will see that the management is repaying some of its debt. It might go down, the debt might go down, but then management needs to kind of pick up debt to do some capex and all. If you go to, so yeah, depreciation, PBT tax, I've taken 25%, so PAT comes to this. Now the investment is 12, cash I've calculated in a way. The EBITDA to CFO is for the last quarter was 94%, and I think it would stay in that range because the base business is a cash thrower, and the new business that is kind of slowly becoming better. The top line is growing and the bottom line is improving for that. So my CFO comes down to 102%, 102, and it extends. I mean, every year, whatever cash is getting generated, and I'm kind of calculating. So I feel like by FY28, your CFO will be around 217, taking 80% EBITDA. Sorry, CFO to EBITDA conversion. So sorry. Yeah, and your free cash flow, because last year there's no capex, so yeah, but this is your free cash flow, and generally your cash would be around this level, and last year there would be a substantial amount of cash. This might go up and down depending on the capex, because as the management generates more capex or cash, they'll probably deploy into newer and newer businesses and expand and all of those things. Um, I feel from next year onwards, or the year later, a larger amount of capex will go into this Yojin, and I won't be surprised if this goes to more than say 300 crores odd. Yeah, and then we can have a very different story over here. Okay, borrowings are as is. I mean, we don't change, and EV kind of changes through that. And then I did a bit of my estimate. So my estimate sort of says as if the capex is not that high, then I mean, or estimate sort of says is if the market cap is 991, then probably we get a if we take price to sales, a median price to sales, we get around 17%. If we don't, we take the current price to sales 20% to 16% if the management is able to deliver. If not, then we are in trouble. If it goes to peak, then probably we make a CAGR of between a range of say 30 to 45%. But I'll stick to this 20 to 25%. So maybe 16 to 25% would be the best case scenario. And your bad scenario is when, say, for example, your SGEM revenues don't even come. Yeah. So this that you're calculating based on blah blah blah. So for example, say 60, 100%, 60. So for example, if you say this still remains at say low 40% or maybe 40% sort of a thing because of some derating and all of that. Yeah, then you get a negative. So you actually get kind of negative return. Yeah, you will probably go to median, maybe so base could be around negative 10% to maybe 6% CAGR. Yeah, and if your oops, sorry, if your this also kind of where am I? Yeah, if your industry also kind of degrows and these guys starts degrowing. So for example, you start getting a um, so negative 10% over here. Say you get a negative 10% drop in sales. You don't really go up, but you actually drop in sales. In that case, your base case scenario even becomes bad. One sec. You can bearish case scenario is kind of negative 17% CAGR to, I mean, you actually see a 50% drop if the management is not able to deliver. Yeah, so that's the main risk with this business because it's already so expensive. All right, then that's about it. Thank you.